When stock market prices are falling for several days in a row, many investors sell their shares. However, by doing so they miss out on the best sessions, and this has serious long-term consequences for their investments. If the price of a security falls during a trading day, most savers are not shocked. But when the downturn begins to last for several days, serenity quickly gives way to uncertainty, concern, and sometimes even panic, perhaps fueled by gloomy economic forecasts from experts. In order to prevent the savings accumulated for years from evaporating further, many investors sell their shares in these moments, thus accelerating the general fall in prices. However, these collapses are then followed by recoveries, and not by a small margin. The typical behavior of some savers who sell driven by panic leads them to buy shares again only after a significant increase in prices, and thus to miss the best days on the market. This has a significant impact on long-term returns. As a basis for their conduct, investors should first assess what risks they are able to take. For example, it is unwise to buy shares with money that will soon be needed for the renovation of a house, the purchase of a car, or for medical treatment. It could take years for prices to recover after a crash. Secondly, the level of risk investors want to live with also plays an important role. For example, those who are close to retirement are likely to remain more cautious, to avoid putting part of their retirement savings at risk. Instead of simply buying stocks and holding them for an extended period of time, interested investors can also pursue a somewhat more elaborate strategy. The prices of individual stocks move differently than indexes, and a so-called rebalancing can prevent individual positions from becoming too big a risk. This involves, for example, selling some of the shares of companies that have performed very well and using the proceeds to buy other stocks that have performed poorly. Depending on the portfolio, it is of course also possible to invest the proceeds in other investments, for example in real estate or gold. Here too, however, a long-term strategy with reasonable criteria is advisable. Investors usually lose money as a result of emotional decisions in the short term. Those losses have major impacts on the long-term performance of a portfolio. For that reason, it is extremely important to never lose sight of the long-term criteria that were implemented in the asset allocation of a portfolio. This is not investment advice and neither a solicitation to invest. If you desire more information, contact us at +41 91 683 6343 or info@ibex.capital.